All right, guys, welcome back. In today's lesson, I'm going to be blending two high probability entry techniques, being ICT Smart Money Concepts and TheMas7er DR or defining range. Now, if you're watching this video, I take it that you are not new to ICT Smart Money Concepts. At the same time, you are not seeing TheMas7er's defining range for the first time. Now, if you're seeing the defining range, the DR/IDR for the first time, you have to go watch that video because I'm going to be talking about that in this video. So the link is going to be in the description box. Go watch that video. It's a 10-minute video or a 15-minute video, and then you can come back to this one. Now, if you look at my screen, you'd find that I have what looks like an order or a hierarchy. This is how I blend both of them together to form a very high probable entry technique in my trading. Now, I would have released this a long time ago, but I allowed for time to pass in order to do this. So let's go straight into it. Now, how am I blending these two concepts? Here's what I'm doing. The higher time frame takes precedence, as you can see here on my screen. The higher time frame is at the top of everything that I'm doing. Now, followed by the intraday ICT daily market profile. Now, if I've identified what I intend to do on the higher time frame, there is a market profile that I look for on the daily time frame or on the 24-hour cycle, on days where the market is poised to trade higher or lower. And the next thing would be to determine the high of the day or the low of the day using ICT central bank dealers range standard deviation when applicable. Now, if you haven't watched that video on ICT's central bank dealers range, you want to go to his 2022 month 8 lesson or folder here on YouTube and watch that video, and then you can come back because what I'm about to show is very simple. Now, once I've taken that into account, then I'm gonna go to the defining range from TheMas7er, and the defining range is considered the setup range. That is what I call it, and you're gonna find out what that is. The setup range consists of the mitigation blocks, the breakup blocks, fair value gaps, order blocks, and so on. So this is going to be the order that we're going to use in every trade. So we're going to break it down as we go forward. Now, elements that make a setup high probability using or blending both ICT and TheMas7er's concepts. There are elements that I look for over a long period of time. I found the weakness of this system and the strength of this system. And that's what I'm about to show you here today. So the trade direction, number one, must be in line with the higher time frame, the daily time frame. Okay, so the trade direction that you are looking to take must be in line with the higher time frame direction or sentiment. In the case of trading a pullback, a counter trend trading, there must be a reaction to a daily or a H4 PDA or PDRA. The intraday market profile for that day must be identifiable. It could be a delayed or a normal protraction classic buy or sell day, power of 3 ICT concept. Number 4, ICT central bank dealers range, the standard deviation, which we use to identify or determine the high or the low of the day, must be used when applicable or should be used when applicable. It doesn't always apply, but when applicable, it should be used. Now, at this point, the DR or the defining range must agree with the overall direction so far. So it must agree with the overall direction so far, We're going to go into examples after this, and you're going to understand all of this. These are the rules that I use. Now, for a sell day, upon the closure below the overnight defining range, which is what we use, the high probability bearish reference points, be those mitigation blocks, breakup blocks, fair value gaps, order blocks, etc., will form within the defining range. As you can see here, we have the defining range. The fair value gap will form inside the defining range. And you can see the overall structure. This is one of the traits that make it high probability when the reference points, be that order blocks, fair value gaps, breakup blocks, mitigation blocks, when they form inside the defining range, there is an 88% chance that price will not go above the high of your reference point or above the high of the defining range, which we have here as the gray box. For a buy day, upon closure above the overnight defining range, the high probability bullish reference point, be that a mitigation block, a breakup block, fair value gap, or other block, will form within the defining range. You need to see the master's video, like I said, on YouTube, link in the description. Now, this is what combining everything that I just talked about so far would look like. You have the higher time frame sentiment. In this case, we're looking at a bearish market. It is bearish. And then the daily market profile could be a normal protraction sell day within that trading kill zone, be that London or New York. In this case, it is a normal protractionary sell day, okay? Now, we're going to come in. We've identified that we are in a higher time frame bearish marketplace. We move into the 24-hour cycle or the 24-hour day, and we find a normal protractionary sell day after midnight New York. And what we're looking for next, the third thing would be to look for the defining range to make sure it agrees with everything so far. And then we're going to combine the structure and look for a setup within the defining range. Now, you know that a close below the defining range would signal that we are bearish, but we have two more confirmations before the defining range, of course. Now, upon the defining range agreeing with all these other two, we start to hunt setups inside the defining range. We're going to go in and hunt setups inside the defining range. We're going to hunt breaker blocks, in this case, a fair value gap and a breaker block. Now, when price returns in there, inside the defining range, inside this structure right here, we're going to be taking an entry for the closest liquidity pool, and that's going to be our target. For the buy scenario, it is just inverted. You invert the entire thing. We have a higher time frame sentiment, bullish on the daily time frame. Now, on the daily market profile, the 24-hour cycle, we have a normal buy day, normal protractionary buy day after midnight New York. Now, the third thing we're going to do is to look for the DR to agree with everything we've had so far. Now, once that agrees, remember, a close above the DR high signals that we are bullish. If you have watched that video. If you haven't watched that video, I can't help you. I can't go into discussing about the DR. You have to go to the master's video. The link is in the description and watch that video and then come back here. Now, when the close happens above the DR, remember all of this is already in the works. We look for price to return into the structure here. Displacement lower, huge displacement higher, a return into that fair value gap or breaker block. Remember, the setups will form within the defining range and or the ideal defining range. They're both called the same thing. So what I'm saying is your high probability setups will form inside the defining range after the market has taken out or manipulated during London. Displacement lower, take draw on liquidity, and the displacement higher. Now we're going to look at some examples. Now we are on the pound dollar daily time frame. Our attention is going to be drawn to the 22nd of December 2022. This is not cherry picked, but our attention is going to be on this day. Now, before going into the lower time frame, you're going to see that price was trending. We had a trending market to the upside, a bullish trend. But then we had this liquidity pool taking out, and then price returned with energy, and that happened fast on the daily time frame. Now, the best times to take a trade off of the daily time frame, whether you trade anything, would be after a pullback on a particular move. You want to go either on this one or the day after the continuation. D2. I'm going to call that D2. So that's the reason why we're going to be focusing on the 22nd of December 2022. And we identify that this day is a sell day. So we're going to go to the lower time frame now. Now we are in the 30-minute time frame for the same pair. And this would be December 22nd, 2022, right there. And you can see the midnight candle because we use the midnight. Now, it's not very clear here on the 30-minute time frame, but we're going to go to the 15-minute time frame in a moment. We have the 30-minute time frame. We have midnight. Price trades higher into a fair value gap right there. What we're looking for is to pattern this particular setup the same way with the model that I showed you. And so we're just going to do that in a moment, and we're going to go to the 15-minute time frame. And in the 15-minute, or on the 15-minute, you can actually see we have price returning in here to a fair value gap. The more you break down, you'll find that this also is an order block. So price breaks down within the London kill zone. London kill zone. And I want you to pay attention to the hierarchy, higher time frame, bearish reversal after the buy side liquidity draw. And number 2, intraday market profile, delayed protraction. This would be a normal day protraction. Normal day protraction, sell day, and the DR protocol would agree, and everything ticked the box. And the setup would be a bearish order block within the DR right here. Now we're going to go drop down to one more time frame, the 5-minute time frame, before calling this one off. Now we are on the 5-minute time frame, as you can see. Now on the 5-minute time frame, I beg your pardon, we have more details. Now, as you can see right here, the price reacted to that fair value gap. If we break out further, you'd see that fair value gap right there. After midnight, there was a draw on the buy side liquidity, which was the Asian range high, and a huge displacement further down. So the entry would have been, an early entry would have been around this breaker block, and the entry we were referring to would have been here, this order block, which appears to be a mitigation block on the 5-minute time frame. This is the break below the defining range, which confirms that we would start looking for setups within the defining range. On the 15-minute time frame, that would have been a bearish order block. But on the 5-minute time frame, that would have been a mitigation block, still within the defining range. Price would have traded lower, 52 pips. The stop would have been above right here, 11 pips. And all of this would have happened within the London kill zone approaching the New York kill zone. That's going to be it for this example. We're going to visit one more example. Now we have a second example. That would be euro dollar, the 26th of January, 2023. Now, this is most recently. Now, on that day, we had after midnight, we had price taking out buy-side liquidity, which was the Asian range just before the Asian range high and the Asian range low, and a huge displacement after that. Now, we're going to bring the defining range, or the DR, and we're going to go to the 5-minute. But before going to the 5-minute, I want you to see price returned into the fair value gap. If you break down to the 5-minute time frame, you would find a breaker block. And on the 5-minute time frame, you're going to find that we have more detail. We have a bearish breaker block and a fair value gap in the same vein, or in the same, or overlapping each other. And we had price returning in there and trading lower for a 1 to 4 hour. This would have been a 38 pip target and a 9.1 pip stop. Now, I'm going to be covering cautions to take note of when implementing the DR and IDR concept with SMC, of course. Now, everybody's taking the DR and making use of it, but there are times when it appears to be weak. And one of those times would be on days with high impact or multiple high impact news events, such as the CPI, the NFP, or the FOMC. The probability of this method goes down during those periods. You cannot really trust it around those days. So it'd be best to stay out. Another problem would be when the DR is pointing or indicating sentiment in the direction of a previous day's high. We're gonna look at an example just in a moment. When the DR is pointing or indicating sentiment in the direction of a PDH, a previous day's high or a previous day's low, the liquidity that has just been taken out and is against the daily market profile, we ignore it, as this is an early direction, which usually changes. We're going to understand what I'm talking about in a moment. In such days, it is best to focus mainly on the daily time frame, the higher time frame sentiment, and the intraday market profile for your buyers. Now, the DR will usually agree with this later, that is before or during New York. On days when both intraday market profile and DR are undecisive, usually during London, it is best to wait for New York, especially when the previous day was a large range day. So what do we mean by this? So we're going to look at an example for number 2, when the DR sentiment is indicating or pointing to a direction that is in the direction of previous day's liquidity, or previous day's high or previous day's low, and the liquidity just got taken out, and the DR is pointing to that direction. It is best to stay out of it. We're going to look at an example of what that would look like. And we have an example of what I would be referring to. Now, on this day, we had price and everything was perfect, and price traded lower. I want you to look to the left side of the chart. We have a previous day's low sell side liquidity resting below that. On this new day right here, we had the defining range, and price closed below that. Now, if the defining range is pointing or indicating to a direction which is a previous day's buy side or sell side liquidity, and price has just reacted to that, and the defining range is pointing that we are going to be going in that direction, you want to ignore it for at least that time of day until New York, that is. Now, it takes out that liquidity pool. I won't pay attention to this on this day. After taking out the sell side liquidity pool, what happens? There's a huge displacement, which means we're going higher. And during New York, right here, we return to this bullish breaker block. I'm going to take this off. We return to this bullish breaker block right here, and price trades higher. That would be the example of what I mean when I say we do not trade in the direction of already violated buy side or sell side liquidity, even if the defining range points to that direction. Remember, we have a hierarchy of confirmations that form our setup requirement, and that's what we're going to be following. Until next time, be safe, guys.